Hello and welcome to Wisdom Bites. Hope you're well. Thank you once again for joining us. Very much appreciated. And in today's video, I'm going to try and fit in a life-changing wisdom bite. So hopefully if I've got some time at the end of this video, I'm going to do a wisdom bite on a book that you may actually have heard of. In fact, I'm very convinced that you've probably already heard of it, but it's a message within that book which I think we need to just freshen up again. And that is a book called Rich Dad Poor Dad. Truly a life-changing book. But before then, I'm going to show you some very important developments on the various time frames and why October is going to be an absolutely critical month. So if that sounds interesting, then without further ado, get yourself a cup of tea, sit yourself down, eyes on the screen, and let's get cracking. So I'm going to start off with the daily chart here. And what we've got is a descending triangle with this price action contained within it. And what you've got with the blue line is the 8 EMA. The 8 exponential moving average. And as you can see, we look as though we're going to be having a big move either to the upside or to the downside by the pressure that's been created by this 8 EMA coming closer and closer to this base support line here. So we can see quite clearly that when we lose the 8 EMA, we tend to have a big breakdown. We use it as the resistance and then as support, and then back to resistance here. So it's a very important critical moving average for Bitcoin. And as you can see, when we lost it here on the 13th of September, we've been using it as a resistance all the way along here until last week when we managed to get above it, but it wasn't strong enough to maintain its position. And now we've lost it again over the last 3 days here. And if we zoom in, we can see in the last 3 days when we lost the 8 EMA, we're using it as resistance again. But this time, the gap between the support, which is down here around about the 18,900, and the 8 EMA, which is 19,200, this range looks to me is going to be breaking very shortly. So while the 8 EMA is going to be coming down here, the price is going to be having to move out of it, either to the upside or the downside. And since this is a descending triangle, the stronger probability is for it to break to the downside. And the question then is, are we going to test the 17,500? And as a result of what's happening here, I can tell you what my strategy is. For my long-term portfolio, as I've said many times before, I'm thinking that 75% the bottom is in here. However, in the last video I showed you on the monthly chart, we've lost the very strong support line on the monthly chart, which has actually increased the odds for it to go much further. So I would say that that probability of 75% to 25% of this being in has now gone to 60-40 in favor of this being the bottom at 17.5. And the reason for that is that on balance, there are still many more indicators that are saying that the 17,500 is in as a bottom. But some changes in the charts are telling us that the odds are going more towards the downside. However, as a contrarian, if you look at the fear and greed index, everybody here is expecting the price to go much, much further. And the contrarian view, which tends to work out much closer to the truth and accuracy, would say that we've more than likely bottomed out here. So there are some very good strong indicators, and I've shown you all the averages in my previous videos of why all these averages from a historical context are saying that this 17,500 is in. So I would now say, in conclusion to this bottom being in or not, that 60% this bottom is in, 40% it could still go much further. So we'll only have to wait and see. And the strategy for me anyway, and please remember, this is not financial advice. Always do your due diligence before you make any important decisions. I can only give you my perspective of what I'm thinking and what I'm doing. In my long-term portfolio, I've taken a 75% position as this being the bottom. With the 25%, if this falls down towards the 14,000, I would be able to pick up 25% at that point. If not, then my strategy is to add and dollar cost average at these two main levels here. The 13th of September top here at around about 22.5. If we can capture this, then I would increase my long-term portfolio here. And if we capture this 25,000, then I would increase a little bit more there. And I think the final level for me would be the 28,000 here. For me, that would confirm over here that this bottom is now in. So that's just from the strategy point of view of what I'm taking. Obviously I can be completely wrong, so please do your wider research. And one of the main reasons why there is so much uncertainty in the market is because of the dollar. The DXY chart here shows quite clearly that the dollar, which has been rising since the American government started to raise interest rates, which has really sucked out any liquidity from all the markets, including the cryptocurrencies. And the narrative behind that is now that in order to control inflation, the government has got a 4.4% target for interest rates. Currently we're around about the 3 to 3.25%, so there's a little bit more to go. And as they increase interest rates in the next few months, and this is the monthly chart here, we can still expect the dollar to keep rising to maybe this level here. Maybe it's going to top off around about here, which would take it from the 2001 level. So this is where I'm thinking is the ceiling for the dollar here before it makes its expected downturn. And this would make sense because the government will be more than likely, as long as the inflation figures are being contained by the interest rate increases here, the government will be trying to reduce the interest rates from the beginning of 2023, maybe first or second quarter. And that should start bringing the dollar back down and allow the markets to start moving back to the upside. So only time will tell, but this is an interesting development that's going on with the Bitcoin charts and the dollar. Okay, I'm going to move on to the monthly chart here and show you why we are coming to the end of the bear market here and why we can expect, based on historical data here, for the Bitcoin price to either bottom out at the 17.5 and go sideways for the next 2 or 3 months, or to make a new lower bottom before we make the upturn. This is the Blx chart, and as you can see from here, from the beginning of Bitcoin around here, 2010, it took 51 months to bottom out at the end of this first cycle bear market here, back in January 2015. Then we went on this bull run here to 2017, and the end of that bull run was followed by the 1-year bear market, which bottomed out at 3,100 over here in December 2018. And that was 46 months here. So basically, from the bottom where it went to at the start of Bitcoin to the bottom of the bear market at the end of 2014 was 51 months. From that point to the bottom of the next bear market was 46 months. And currently, if we were to take the 17,500 as the bottom, then that would be 41 months from here. So there's a progression from 51 down to 46 down to 41. However, if it's going to be similar to this, then currently we're on 45th month now with October. So either in October, November or December, which is 45, 46 or 47th month, is where we're more than likely, based on historical data here, is where we're going to bottom out before we make an expected turn to the upside. So there's only 2 versions of this really. Either we've bottomed out at 17.5 and we're going to go sideways for the next 2 or 3 months before we go to the upside, or we're going to make a new lower bear market bottom here at around about 12,000 around here maybe, and then go to the upside. So only time will tell, but this is a very important chart which is telling us what the progression has been and that we are very close, as you can see from here, as per the previous cycles, that we are bottoming out and we are coming to the end of this bear market. I want to show you something very interesting on the weekly chart. So this is the weekly chart on the BLX. When we bottomed out here at the end of the first cycle in December 2014, you can see that the Stochastic Rsi, which is your momentum indicator, if you look at right at this point here where it bottomed out, you can see that the Stochastic Rsi was really right at the bottom and it was turning back up. If you look below there, the RSI was exactly at that point. It was below the 30 level that I've got marked out here with the red dotted line. So you can see that both of them matched up, and after that we went on this bull market run here. Similarly, at the end of the 2018 bear market over here, as you can see, the Stochastic RSI was right at the bottom, as well as the RSI below the 30. If you now look at Stochastic RSI was at 17,500, that was right at the bottom with the Stochastic RSI here, at the same time as the RSI. So that would suggest that the 17,500 bottom is in, based on the previous 2 cycles matching up. Currently, as you can see, the Stochastic RSI is towards the top side, and the RSI is just getting out of the 30 zone, but that is exactly similar to the previous two cycles, because once we'd bottomed out, you can see the stochastic RSI started moving to the upside while the RSI was still down here. And similarly for the first cycle, the stochastic RSI had moved to the upside while the RSI was still just above the 30. And we are now very, very similar over here. So some would say, looking at the stochastic RSI, that we have a leg down here. And that may well be the case, and that may well be what pulls it down to the 13,000. However, if we look at the previous two cycles, we are playing out very, very similar to that. And it would suggest that the 17,500 is in. And this momentum indicator, it doesn't mean that if this starts coming back down, that the price will come down. It may well be that the momentum is lost, so this comes down, but the price action remains sideways. And hence that narrative I've just given you in the last chart, that we may go sideways for a few months before we take the upside direction. Okay, only time will tell. If you found value in that information, then please do remember to like and subscribe if you haven't already done so. Just to show you the monthly chart again, but this time with this candle, which is really the one that's very frightening and the one that could really crash Bitcoin to the downside towards the 13, 14 or even 12,000 level. So this is the previous all-time high at 19,800. And if we draw a support line from the top of this all the way across, we can see quite clearly here that this candle, this September close, was below this very strong support line here, and this support and resistance over here, and this 19,800 top back in 2018. When you have a close look at this, you can see quite clearly that the support line has been broken when it closed here at the end of September. And this current candle seems to be going more towards the downside, but I wouldn't be convinced of this candle yet until we go below the wick of this candle here at around about 18,150. So uncertain times ahead, but I've shown you the most important pieces of information in the charts. Okay, on to the wisdom bite for today. A quick look at the book by Robert Kiyosaki called Rich Dad Poor Dad. If you haven't already read that book, then I would strongly advise you to read that book and to take the main points from there. And I'm going to just review those two main points from the book. The first one is that the poor buy liabilities. So poor people, they buy liabilities. And what that means by liabilities is that it takes money out of your pocket. So on a weekly or monthly basis, the poor buy liabilities which take money out of their pocket. Example, if they've got a property they live in and they're paying a mortgage, that takes money out of their pocket. If they're renting, that takes money out of their pocket. If they've got loans to buy cars and holidays and boats and credit cards, all those types of things take money out of your pocket. And by the poor, I don't mean just the lower classes. By the poor, I mean the middle classes as well, because they're very, very keen on buying things on credit. You see, the middle classes, they want to look wealthy, so they'll buy the BMWs, the Mercedes cars, but they'll buy them all on credit, which is taking money out of their pocket. And that keeps them poor, while the appearance might be that they're looking quite wealthy, but that's not the case. The rich, now they are very clever. They buy assets, and with assets, they put money into your pocket. Whereas with liabilities, the money is going out of your pocket. The rich buy assets which are putting money into their pocket. By which I mean that they buy properties which they rent out, which brings money into their pocket here. They buy commercial properties and they rent them out to companies. That brings money into their pocket. They invest money on stocks and shares, which increase in value, and that puts money into their pocket, etc., etc. So if you want to be on this side of the fence, you have to avoid this and get into this. Unless you're going to win the lottery, this is the only way to be on this side of the fence, on the rich side. And I can tell you that this equation here at the top is 90 to 95%, and this part of the equation for the rich is about 5%. And that's not going to happen overnight. It's not going to happen within a few days or a few months. It may take 10, 15, 20 years, but at least decide to do that. The main thing is to decide to move from this side of the equation to this side of the equation. So now I'm going to give you the second major idea within this book, which helps you to look at exactly where you are and where you need to go to be able to do this. So Robert Kiyosaki, who wrote the book, drew a quadrant. So in the quadrant, he drew these letters E, S, B, and I. The E is for an employee. The majority of people in any country are always on this side of the quadrant with the E. And you could be making anywhere between the equivalent of, in the English pounds, from £20,000 salary to even £100,000, £200,000 salary as an employee. And the reason why, even with a high salary, this is the wrong place to be is that you are paying full tax before you get money in your salary. So before you get your paycheck, the government will take out all your taxes at that point before you get your salary. So those people here are the most heavily taxed people anywhere in the world. The S here is for self-employed people. With these, I mean all the professional people as well, those who are doctors and lawyers and engineers and who have their own little businesses, and at least they can put their expenses in for the work they carry out, and that can be taken into account before they get taxed. So whatever service they're providing, whatever business they're doing on this self-employed basis, they can put in their expenses that are required for them to provide those services before they get taxed. And that helps their tax position better than the employees over here. However, the big problem with this is that you are only earning when you are offering your time and effort in the pursuit of your career. So if you're a lawyer, you're only getting paid when you're doing the job of the lawyer. So that keeps people very much contained within a certain ceiling in terms of their wealth. They're still better than the E. They're not as good as the B over here. And the B means this is a business owner with over 500 employees. That's what he meant in the book. However, it can mean any large businesses where you're offering shares and dividends in the company. And once again, you're only being taxed once you put all your expenses in. And there are many perks that business owners get which allow them to actually reduce their tax liability. And you must have heard of these large companies, especially like Apple, like Google, like Netflix. They operate all across the world, but as a proportion of their profits, they pay a very, very low percentage tax compared to the employees or the self-employed here. So this is the next best position to be in. However, if you're in this is where we should all be aiming for. This is where you do the least amount of work for the most amount of money. And these are the people who are the large investors who have large investments in various holdings. These are the ones who are having passive income. So they're doing nothing virtually, just making the right decisions and getting the most amount of money coming into their pockets. So they have investment income, they get capital gains, paid lower taxes, and do the least amount of work. This is what you call the lazy man's way to riches. So the question is, where are you in this quadrant here? Are you an E, an S, a B, or an I? Okay, so we'll leave it there. I hope you found value in the video, and if you did, then please do remember to like and subscribe and to turn on the notification bell. And if you've got any comments, questions, or suggestions, then leave them in the comments below. Until the next time, take care, stay safe, and I'll see you in the next video. Bye for now.